In this lesson, you're going to learn about how deferred tax liabilities work, how they're reflected on the three financial statements, and how you would incorporate them into a three-statement projection model like the one that you see in front of you that we've created for Apple here. Now, just to review, in the previous videos in this course, we went over how to create projections for the three financial statements, the income statement, balance sheet, and cash flow statement. And in the course of doing that, one of the items that we touched on but didn't go into a whole lot of detail on was this notion of deferred tax assets. And on the liability side, the corresponding entry would be deferred tax liabilities. And we went over why they occur, which is basically that a company can often record a certain income tax expense, but then they can actually defer paying part of it or all of it sometimes in terms of actual cash payments. So on their income statement, they may have a number written down for the income tax expense that they actually owe. You can see that right here under income tax provision. But when it comes to actually paying the government in cold hard cash, they may be paying a completely different number from what's listed on the income statement. And when that happens, it shows up on the cash flow statement as a deferred income tax expense. And what happens is on the balance sheet, it's reflected as either a deferred tax asset. If, for example, the company's paying more in cash than they actually owe, it would be a deferred tax asset because it means that they're going to get some of that back in the future. If, on the other hand, they are paying less in cash than what they actually owe, it means that their deferred tax liability is going to go up. And you can really model a lot of these tax changes by modifying either the deferred tax liability or the deferred tax asset. One change you can apply to the other, you just do the inverse. So if you add to a deferred tax asset, you could do the same thing by subtracting from your deferred tax liability and vice versa. So I'm just going to go through a very simple example now here at the bottom and show you exactly how we would incorporate this into a three-statement projection model. What I've created here at the bottom is a simplified view of a typical projection model that we have up above. And I've done this because I want you to focus on the concepts here as opposed to all the details that you see above with the three statements. So I've taken out the key elements here, and we're just going to focus on what happens in terms of the income statement and then what happens with some of the balance sheet items and cash flow statement items that you see down here. So first off, let's just go up to the top and enter some basic assumptions. We're going to assume a 40% tax rate for our purposes because this is not Apple we're going to be dealing with. This is just some other company. We're just picking a 40% tax rate to keep things clean and simple here. For the initial PP&E number, I'm going to say 300 here. So we have initially 300 worth of PP&E that we're going to depreciate over these 3 years from 2010 through 2012. For the initial deferred tax liability, I'm going to say 0, so we're going to assume that we have nothing on our balance sheet right now. And for the depreciation percentage, so this is where things get interesting because this is something we haven't discussed before. But the basic concept here is that companies have two sets of numbers. One is their book numbers. The book numbers refer to everything that you see above right here. So anything on their financial statements that shows up in public filings or anything that we're going to project, those are book numbers. But when they go and report their taxes, they also have tax numbers. And usually these are similar. And a lot of the items are actually exactly the same, but there are some differences. One difference between these two different methods of accounting is that when you have assets, oftentimes you will depreciate them at different rates for book purposes and for tax purposes. So for book purposes, companies will often depreciate assets using what's called the straight line method. So they'll pick an even number and they'll say over 10 years, 1/10 of the asset depreciates each year. So each year you have a 10% depreciation charge. So in this case, if we had 10 years, this means that 30 of our initial PP&E balance would depreciate each year. By contrast, often with tax accounting, you depreciate more in earlier years and less in later years. And the basic reason companies do this is so that they can save on taxes, because remember that depreciation, as we saw up above on our income statement, is tax deductible. Anything from here is subtracted when we get to our operating income, and it reduces how much tax we have to pay. So if a company is depreciating more in earlier years, then that means they have to pay less in tax in those years as well. So to show you a real-world example of how to apply this, what we're going to do here is for book accounting purposes, we're going to say 1/3 of this asset, the initial PP&E balance here, depreciates in year 1, 1/3 depreciates in year 2, and then 1/3 depreciates in year 3. For tax accounting purposes, by contrast, we're going to say half depreciates in year 1, I'm just going to label this as 3/6 to make it easier to see visually what's going on. So 3/6 in year 1, then 2/6 or 1/3 in year 2, and then finally 1/6, around 17% here in year 3. So if you think about these numbers, 1/6 plus 2/6 plus 3/6 adds up to 100% here. So that's what our depreciation of this PP&E will look like. Now for the actual numbers here, I'm going to keep this very simple. So we're just going to say 1,000 revenue in each of the years here. COGS and operating expenses, again, I'm going to keep it simple and just say 500 in each year here. And actually for tax accounting purposes, revenue and expenses on the income statement are usually very similar or the same. In this case, we're just going to keep it simple and say that they're the same because we want to focus on the PP&E in this case. So actually, I'm just going to link this in and just copy this formula around. Now for the depreciation, here's where it gets interesting. So what we're going to do here is go up to our initial PP&E balance and multiply by the depreciation percentage in each year. So for book accounting purposes, we see it's depreciating by $100 in each year. But for tax accounting purposes, I'm just copying these formulas and pasting them with Control V right here. We see that it's actually 150 in year 1, 100 in year 2, and then 50 in year 3. So the depreciation number is actually declining, and we front load most of it so that we're depreciating the majority of the value of our PP&E in year 1 here. For the pre-tax income, this part is straightforward. We're just going to take revenue, subtract COGS and OPEX, and depreciation. Taxes, we're just going to take pre-tax income and multiply by the tax rate of 40%. And net income, we're just going to take pre-tax income and subtract taxes. So I have this formula. What I'm going to do is just copy it over. I'm just using Control V here because I've already set the formatting. I'll select this whole thing, copy it over to tax accounting. And so now we see some of the differences here emerging. And I want you to draw your attention to the taxes line. Because what's happening here is that in 2010, for book accounting purposes, we have 160 in taxes, but for tax accounting purposes, we only have 140. In year 2, it's even because our depreciation number is the same, and then in year 3, we actually have more for tax accounting purposes than we do for book accounting purposes. So it evens out by the end of this period. And so that's the basic effect here of recording one number for depreciation for book accounting purposes and one for tax accounting purposes. Our tax number is different. We're paying less for tax accounting purposes in the beginning, and then later on it shifts and we're actually paying more by the end. So that's the impact here. So what I want to do here is now fill in this item for deferred taxes. So what we're going to do is take what our taxes should be, this 160 number, and then subtract what they actually are, the 140 number here in year 1. So we see that we're basically deferring 20 worth of the taxes that we owe here because we should be paying 160 based on this 40% tax rate, but actually we're only paying 140 because we're recording our depreciation differently according to this schedule right here. So I'm just going to take this formula and copy it across with Control V. And we see here that there's no difference in year 2, and then finally in year 3 it evens out. This negative for deferred taxes means that now instead of deferring these taxes, we're actually catching up and paying back taxes that we owed from previous years. So how do all these changes actually impact our PP&E and deferred tax liability? So our PP&E, I'll show you what it looks like for both book and tax accounting purposes. So what we want to do is take our initial PP&E number and subtract the depreciation here. We're not worrying about CapEx in this case. We're assuming that we have no CapEx just for simplicity, just to show you the concept for this example rather than worrying about all the details. Then we're going to take our previous PP&E and subtract depreciation again and do the same thing. So we see the PP&E here is going down by an even amount each year until it reaches 0 in year 3. I'm going to copy all these right now to tax accounting. We see here that it goes down by 50% in year 1 and then finally reaches 0 in year 3. So if we had a balance sheet for both book and tax accounting purposes, a full balance sheet, the basic difference here is that the PP&E number would be different for both of these, and then also the cash number would be different because of this deferred taxes item. So this is what our PP&E would look like on a book balance sheet versus a tax balance sheet. Now for the deferred tax liabilities, what we want to do here is take our initial balance of 0 And remember that when we defer taxes, we add to our deferred tax liability because that means that in the future, we're going to have to repay this liability. So we're going to add this 20, and then in year 2, we're going to take our previous balance and add the 0 right there. And then in year 3, we'll do the same thing. You see that in year 3, this is where it finally evens out. So we have a deferred tax liability created in year 1, remaining there in year 2, and then finally going away in year 3 when the company finally catches up on the taxes that it owes. Now, if we wanted to, we could also model this out by using a deferred tax asset instead. In that case, all we would do is up here at the top, we could change initial DTL to initial deferred tax asset. And what we would do is we would change this to deferred tax asset, and we would be subtracting the deferred taxes here instead. And this is actually what we're doing on the balance sheet, if you recall our treatment there. So we could really model this either way. It doesn't matter. We just have to be consistent with our treatment. So we see that in this case, if we defer taxes, then our deferred tax asset goes down here. And then finally, when we repay those taxes, our deferred tax asset goes back up to 0 in this case. So we can model it any way we want. I would say most of the time it's more common to see a deferred tax liability, which is why I set up the model like this initially. But that is a quick overview of how deferred tax liabilities often get created with models like this, and how you often see them presented in investment banking and private equity. I would say this is not a very common thing to see in models. If you're going in for interviews, you don't have to worry about this topic that much, but I have gotten some requests for it, so I wanted to add this and explain a bit about how they're created. As we'll see later in the course, deferred tax liabilities could come up via other sources as well, but this is one of the most common places to see them, and also one of the easiest concepts to understand in terms of how you actually create deferred tax assets, deferred tax liabilities, and then how you reconcile the differences and how they are removed in future years.